A leaked batch of IRS records changed everything I thought I knew about taxes. In 2021, investigative journalists got their hands on the actual tax filings of some of the wealthiest humans on the planet. People worth 50 billion, 100 billion, more money than some small countries produce in a year. And what those records showed wasn't fraud. It wasn't offshore accounts or shady deductions. It was something far more disturbing than that. The data revealed that many of these individuals in certain years paid an effective federal income tax rate in the low single digits. Some years they paid literally nothing, $0. Meanwhile, a nurse in Ohio pulling in $75,000 a year is surrendering 22% of every paycheck before she ever touches it. A plumber in Texas earning $90,000 is writing a check to the IRS for thousands of dollars every single April. These are people who get up before dawn, break their bodies and their minds, and hand over roughly a quarter of their earnings as the basic cost of participating in the economy. And the billionaire? The billionaire kept nearly everything. Not because they broke the law, because the law was written for them. Now, before you assume this is some underground scheme involving Swiss bank accounts and phantom shell companies on a Caribbean island, let me tell you the uncomfortable truth. The primary strategy the ultra-wealthy use to avoid paying income tax has a name. Tax attorneys and estate planners call it buy, borrow, die. It's 3 steps. It's completely legal, and it's so deeply embedded in the fabric of the American tax code that eliminating it would require rewriting the fundamental rules of how this country taxes wealth. Once you understand how this strategy actually works, you'll realize that the tax system you've been dutifully following your whole life, the one where you earn money, watch the government take a third, and then try to build a life with what's left, that system is a game designed for employees. The wealthy aren't playing that game at all. They're playing a completely different sport on a completely different field with a completely different rulebook. And nobody told you the rules changed. My name is Andy, and I spend way too much time pulling apart the financial mechanics that separate the people who build generational empires from the people who grind for 40 years and retire with a fraction of what they earned. If you've ever looked at your tax return and wondered why so much of your income vanishes before you can touch it, or if you've ever been genuinely confused by headlines about billionaires paying less in taxes than their own assistants, hit that subscribe button and give this video a thumbs up, because today we're walking through the exact 3-step playbook that the ultra-wealthy use to legally sidestep income tax for their entire lives. We're going to break down the math at every step. We're going to name the specific provisions in the tax code that make each move possible, and I'm going to show you which pieces of this strategy regular people can actually borrow, scale down, starting right now. Before any of this makes sense, you need to understand one foundational concept that changes everything about how you see the financial system. The United States tax system does not tax wealth. It taxes income. That sounds like a minor technical distinction, but it's the single largest crack in the foundation of the entire tax code. And the buy, borrow, die strategy is built right on top of it. If you own a stock and it goes up by $10 million this year, you owe nothing on that gain. Zero, not a penny. The IRS classifies it as an unrealized gain. The value exists on paper, sure, your brokerage account shows a bigger number, but because you haven't sold the stock and converted that gain into actual cash in your bank account, it's not income. It's not taxable. You could sit there and watch your portfolio climb from $1 million to $500 million over the course of 30 years and never owe a single dollar in capital gains tax as long as you never press the sell button. The IRS can see your wealth growing on their screens, but they can't touch it. For most regular people, this technicality doesn't change daily life very much. You still need your paycheck to pay rent. You still sell investments when you need cash. But for someone who already has enormous wealth, someone who doesn't need to sell anything to fund their life because they have other mechanisms to access spending money, this distinction is the entire foundation of their tax strategy. It's the bedrock of Step 1. Step 1 is deceptively straightforward. You buy assets that appreciate in value over time. Stocks, commercial real estate, private equity stakes, ownership in businesses, whatever category of asset tends to grow. The critical discipline is that you buy and you hold. Permanently, you never sell. As long as you don't sell, those gains remain unrealized. They're invisible to the IRS as taxable events. A billionaire can watch their net worth jump by $8 billion in a single calendar year and report almost no taxable income on their return, because that $8 billion isn't a paycheck. It's just their existing holdings going up in market value. They didn't sell a share. They didn't cash out a position. On their official tax documents, they look almost middle class. This is exactly what those leaked IRS records exposed in vivid, uncomfortable detail. One particular individual's wealth grew by roughly $4 billion over a specific period, but their total reported taxable income was around $68 million. $68 million sounds like a staggering sum to people like us, and honestly, it is. But relative to $4 billion in actual economic gains, it's less than 2%. Their effective tax rate on their true wealth increase was practically nothing. You, in the meantime, sold some stock in your brokerage account to cover a car repair or pay off a credit card and got hit with a capital gains tax notice the following January. Same tax code, same country, completely different outcomes. The system isn't broken. It's functioning exactly as it was built to function. It just wasn't built for you. Here's where most people hit a wall. They say, fine, so the billionaire doesn't sell. I get that. But they still live extravagantly. The mansions, the private jets, the $100 million yachts, the art collections worth more than a small town. How do they fund all of that without selling their assets and creating taxable events? This is step 2. And it's the part of the strategy that'll fundamentally rewire how you think about the relationship between debt and wealth. They borrow. Instead of selling $100 million in stock and immediately owing roughly $20 million in long-term capital gains taxes, the billionaire walks into a private bank and takes out a loan. They pledge their stock portfolio as collateral. The bank looks at $3 billion in diversified holdings and says, absolutely, here's a $100 million line of credit at 2 or 3% interest, maybe even lower. The billionaire takes that $100 million in cash and spends it on whatever they want. New compound in Aspen, new Gulfstream, a $40 million painting, doesn't matter. And here's the tax provision that makes the entire thing sing. Loan proceeds are not income. When you borrow money, you haven't earned anything in the eyes of the IRS. You've received cash, yes, but you've simultaneously taken on an equal liability. Nets to zero. No income event. No tax trigger. That $100 million the billionaire just received and spent on tangible luxury, the IRS doesn't collect a single dollar from the transaction. There is no taxable event. The money simply appeared in their account through a mechanism the tax code treats as neutral. Now your brain is asking the obvious follow-up question. Don't they have to pay the loan back eventually? Yes, but the math is so overwhelmingly in their favor that paying it back is almost irrelevant. The interest rate on a portfolio-backed loan at this scale might be 2 or 3% annually. The assets pledged as collateral are growing at 8, 10, maybe 12% per year. They're paying 3% to avoid a 20% tax hit. That spread, that gap between the cost of borrowing and the cost of selling, represents millions of dollars per year in savings. It's financial arbitrage at a scale most people will never encounter, and it's completely above board. Let me put exact numbers on this so the concept goes from abstract to visceral. Suppose you have $50 million in stock. You need $5 million to purchase real estate. You've got two paths. Path A, you sell $5 million in stock. After federal long-term capital gains tax at 20%, you owe $1 million. You walk away with $4 million in cash and a portfolio that's now $5 million smaller. Path B, you borrow $5 million against your portfolio at 3% interest. That costs you $150,000 per year. Meanwhile, the $5 million you didn't sell keeps growing at 8%, generating roughly $400,000 in unrealized gains that same year. You've spent $150,000 to avoid a $1 million tax bill, and the collateral you borrowed against actually increased in value. Run that forward 10 years. In Path A, you lost the $5 million from your portfolio permanently, plus the $1 million in taxes, plus a decade of compound growth on that money. In Path B, you still own the full portfolio, it's been compounding untouched, and your total interest cost over the decade was about $1.5 million, still cheaper than the $1 million in taxes you would have paid in year 1 alone, before even considering the lost growth. The gap between these two outcomes is potentially millions of dollars, and it widens every single year. The banks are thrilled with this arrangement, by the way. They're lending to someone with billions in verifiable liquid collateral. There's virtually zero credit risk. If the market drops, they simply request additional collateral or reduce the credit line. The ultra-wealthy borrower is statistically the safest client the bank has ever served, so the interest rates stay at rock bottom, often lower than what an average person pays on a home mortgage. This is why you'll occasionally see reports of billionaires who officially earn a few $100,000 per year while sustaining lifestyles that cost tens of millions annually. They're not faking their tax returns. They're genuinely not generating reportable taxable income. They're generating loans, and loans simply don't appear as income on a 1040. But the most elegant part of the whole strategy, the final move that transforms a clever financial hack into a dynasty-building, perpetual motion machine, is step 3: die. That sounds morbid, but stay with me because this is where the entire cycle achieves its most powerful form. Under current United States tax law, when you die, your heirs receive your assets at what's called a stepped-up cost basis. This single provision might be the most consequential and least understood rule in the entire tax code, and it's worth understanding completely. Here's how it works. Say you purchased stock 30 years ago for $1 million. Today, that stock is worth $50 million. If you sold it while alive, you'd owe capital gains tax on $49 million of accumulated gains. At the federal long-term capital gains rate, that's roughly $9.8 million owed to the IRS. A massive bill. But here's what happens if you simply never sell. You hold those shares until the day you die. Your heirs inherit the stock and the IRS resets the cost basis to whatever the market value is on the date of your death, $50 million. Those $49 million in gains that accumulated over 3 decades? Erased, gone, wiped off the books, never taxed, not by you, not by your children, not by the IRS, not by anyone. They vanish from the tax system entirely as though they never existed. Sit with that for a moment. A lifetime of investment growth, potentially tens of billions of dollars across a massive, diversified portfolio, gets completely scrubbed clean at death. The enormous tax bill that would have been owed had those assets ever been sold simply evaporates. Your heirs start fresh with a brand new, stepped-up cost basis, and they can immediately begin the cycle again from the top. Here's the next move in the playbook. The heirs inherit both the assets and the outstanding loans against them. But because the cost basis just reset to current market value, they can sell a portion of those inherited assets with zero capital gains tax, since there's no gain relative to the new stepped-up basis, and use that cash to settle the loan balances. After paying off the debt, they still control an enormous fortune. Or even smarter, they skip the selling entirely. They keep the inherited assets, take out fresh loans against them using the same borrowing strategy their parent perfected, and the cycle continues seamlessly. Buy, borrow, die. Generation after generation. The wealth compounds. The tax bill stays at or near zero, and the machine runs indefinitely. The sharp follow-up question is about the estate tax. Doesn't the government take a 40% bite when you die? In theory, absolutely. The federal estate tax rate is 40% on estates exceeding roughly $13.99 million per individual in 2025, about $27.98 million for a married couple. But in practice, the ultra-wealthy deploy a constellation of legal tools designed specifically to minimize or eliminate this tax. Irrevocable trusts established decades before death can move billions of dollars outside the taxable estate entirely. Grantor-retained annuity trusts, charitable lead trusts, family-limited partnerships, dynasty trusts. These aren't exotic strategies reserved for criminal masterminds. They're standard, well-documented, and used by virtually every family with significant wealth and a competent estate planning attorney. The estate tax, in practical terms, is largely optional for the people it was theoretically designed to affect. So let's pull the camera back and look at the full picture from above. A billionaire buys assets that appreciate for decades without ever triggering a taxable event. They borrow against those assets to fund their lifestyle again without creating any taxable income. They die, and the accumulated unrealized gains disappear permanently through the stepped-up basis, once again generating zero tax. Their heirs inherit a fortune that's been growing completely tax-free for an entire generation, pay off the inherited debt using the tax-free stepped-up sale, and restart the machine from scratch. The total federal income tax paid across this entire multi-decade, multi-billion-dollar wealth cycle can be effectively zero. Every single step is legal, documented, and sanctioned by the tax code itself. So here's the question that actually matters for your life. Can regular people use any of this? The honest answer is yes, partially, but with some real limitations you should understand. You probably can't walk into a private bank and borrow $100 million at 2% interest, but you can hold your investments for the long term and stop selling them unnecessarily. Every time you sell a stock to chase a hot tip, rebalance your portfolio out of anxiety, or take profits just because a position went up, you're voluntarily triggering a capital gains tax that a wealthier, more patient investor simply avoids by holding. Holding isn't just an investment philosophy, it's a tax strategy. Time itself is a tax shelter that everyone has access to. You can also use securities-based lending on a smaller scale. Most major brokerages now offer margin loans or portfolio lines of credit to retail investors. The rates won't be as favorable as what a billionaire receives, and the risks are meaningfully higher when your portfolio is smaller, because a market downturn could trigger a margin call that forces you to sell at the worst possible time. But the mechanism exists. You can borrow against your investments instead of liquidating them, deferring the tax event while your assets keep. Compounding. And here's something critical that almost nobody talks about at kitchen tables. The stepped-up basis at death applies to everyone. It's not restricted to billionaires. If you hold appreciated assets, stocks, real estate, whatever, until you die, your heirs get the full step up. For many families, this means the smartest order of operations in retirement isn't to sell your brokerage account first. It's to spend down your traditional retirement accounts, your 401k and your IRA, where every withdrawal gets taxed as ordinary income regardless, and let your taxable brokerage account pass to your heirs untouched with a fresh, stepped-up basis. The gains you spent a lifetime accumulating get passed on tax-free. That's real, significant money kept in your family rather than sent to the IRS. And it doesn't require a team of expensive lawyers to execute. The deeper lesson beneath all of this goes beyond any single strategy or loophole. The tax code, at its structural core, rewards asset ownership and punishes earned income. Every dollar you receive from a paycheck gets taxed immediately. It's reduced before you can invest it, before compound interest can touch it, before it has any chance to grow. But every dollar of appreciation inside an investment you haven't sold sits there completely untouched by the government, compounding freely for as long as you have the patience and discipline to hold. The longer you delay a sale, the longer your money grows without the IRS skimming from the top. Patience and ownership aren't just investing virtues. They're the most accessible tax strategies available to ordinary people. This system isn't going to reform itself anytime soon. There have been proposals to tax unrealized gains, to abolish the stepped-up basis, to close the borrowing loophole that makes Step 2 possible. Every few years, some version of these ideas surfaces in a political debate or a campaign speech. And every time, the proposals face overwhelming resistance from the people who benefit most from the current rules, who also happen to be the people with the most political influence, the best lobbyists, and the deepest relationships with the legislators who write the tax code. Waiting for fairness isn't a viable financial plan. Learning the rules as they actually exist right now and positioning yourself within them is the only strategy that produces results today. Here's what I want you to take away from this. Stop thinking about taxes the way your employer's payroll department trained you to think about them. You're not permanently locked into paying the maximum rate on every dollar you ever earn. Learn the real difference between ordinary income and long-term capital gains. Understand exactly when selling an asset creates a taxable event and when holding it avoids one. Start building a portfolio of assets you genuinely intend to own for decades, not trade for short-term gains. And if you're building anything resembling real wealth, talk to a qualified tax professional about how to structure your estate so that your family doesn't hand the government a 6- or 7-figure check for money that could have remained theirs through a simple step-up in basis. Buy, borrow, die isn't just a playbook for people with private jets. It's a window into the actual architecture of the American tax code. And once you see through that window, you can never unsee what's on the other side. The people at the top aren't breaking any laws. They're following a completely different instruction manual, one written specifically for people who own things rather than people who earn things. The only question left for you is whether you'll keep running the employee playbook forever, trading hours for dollars and paying taxes on every single one, or whether you'll start building like an owner and let the same tax code that punishes your paycheck start working in your favor. If this video changed how you think about taxes and wealth building, share it with someone who's still grinding under the assumption that working harder and earning more is the only way forward. It isn't. The real path forward is understanding the system deeply enough to stop leaving your money on the government's table. Hit subscribe because we're going to keep pulling apart these invisible financial mechanics until the playing field starts making a lot more sense. Thanks for watching, and I'll see you in the next one.